Hello and welcome to the Benzinga podcast. Hello and thank you for joining us on today's installment of the Benzinga podcast. I want to start off by thanking the listeners, and I want to briefly remind everyone that the easiest way to get the Benzinga podcast in the future is to subscribe in iTunes. You can find a button to do that right off of the Benzinga homepage. On the show today, we have John Burbank. John is the founder of the hedge fund Passport Capital.
Hello and welcome to the Benzinga podcast. Today our guest is John Burbank, founder of the hedge fund Passport Capital. How are you doing today, John?
I'm doing fine, thanks.
Great, glad to hear it. Let's get started with questions. Could you tell our listeners how you got started in finance and money management?
Well, I started investing went to business school at Stanford, but it wasn't until I was about 30 years old when I decided on my own to start trading. I borrowed $50,000 in credit cards in 1994, and I started trading in the market really as a test to see if I enjoyed doing it and if I wanted to pursue this. I'd been more of an entrepreneur, small business guy, which had paid for college and business school, and this is really it was a hypothesis for me. Maybe that I was interested in it. Maybe I would do this investing instead of business. And so that's really how I started.
Okay, and you said so you're an entrepreneur. What kind of businesses did you start?
So my dad is a teacher, didn't have any money, and had to pay for college. And I found a company called College Pro Painters that trained students how to run their own house painting businesses. And they claimed that you could make $10,000 in a summer. This is back in 1985. So $10,000 was a lot of money back then. And this is really the only alternative I had, so I did it, and I actually made $11,000 that summer. And in the third summer I made $35,000. So, and that was sort of hiring 12 to 15 college students and getting jobs, overseeing the production, all those kinds of things. So that really opened up my eyes as to that maybe the world of business was something that I could do, and it was purely based on necessity and my desire to, support myself.
Now, everyone knows about how hedge funds have these sky-high returns, but what exactly differentiates a hedge fund from some of the run-of-the-mill investment funds and managed accounts that most investors put their money in?
The primary thing is the alignment of incentives. The hedge fund gets a share of the profits, so is very oriented towards making money, regardless if markets are up or down. That's a big thing. Secondly, tend to have a much wider open mandate about what to invest in, which of course could be a bad thing or a good thing. And the compensation structure, because it is aligned and it is cut of the profits in addition to management fees, attracts a very high caliber, the highest caliber investor. I mean, it can attract a lot of greedy people, and not necessarily all talented people, but the most talented people in the money management industry generally choose to have the best compensation structure, one where their efforts are rewarded if they succeed, and that's really, I think, how it's come about.
And hey, they got a talented money manager like you in the business, right?
Well, I've learned with time that some of my hypotheses were right, like markets are not very efficient about big changes, that looking medium to long term is an effective way of investing instead of purely short term, that research and doing your own research really can pay off because markets often do not reflect reality. Think about how people learn and how they trade markets. People learn very slowly. We all read at relatively the same rate. So in terms of processing new information. We're all heavily constrained by our ability to read, to hear, to experience things. So you have to develop other ways of doing this. I've decided to have a large research team and go after many things that I think are increasingly relevant. It was energy. I've been doing energy for 10 years now, but I knew nothing about it when I started. Been doing mining, gold and other mining for 8 years. I knew nothing before I started. Been doing India for 7 years. Knew nothing about it before I started. Those kinds of things. So what I've learned is that people learn relatively slowly, that it's hard to make sense of information that you're previously ignorant of, and that the utility in the stock market or investing, because you have other people's money for such a short period of time potentially, there's a lot of utility in the near term, and I think traders and investors orient around high-frequency expected upcoming events like quarterly earnings announcements or job reports or whatever, and they effectively and efficiently discount those expected events, and then they get the information, which is how the market learns, and then effectively discount it right after. So all that is, I think, very efficient. What's inefficient are these big things where there is no announcement, where it isn't expected, where there's no easy analog for people to refer to. And when you have this new big thing that's happening, could have been the internet in the 90s, or China in the last decade, or resource scarcity, or many different things, it takes a long time for people to figure out what it means, the magnitude of it, what it's going to affect. And it takes many years for the market to become, so to speak, expert about it.
If it takes that long for the market to learn about it, how do individual traders and investors try to take advantage of these things that are happening?
Well, everybody comes at it in their own method, their own time frame, their own with their own risk profile. If you're trading stocks, then you put it in that context. But when you have something like China, for instance, where the Chinese stock market was completely irrelevant until about 5-6 years ago, and then suddenly you have a universe of thousands of companies that are you've never heard of in an economy that you previously didn't think about, and then it takes you a lot of time to understand what's relevant in there. Should you pay attention? All kinds of things. But in essence, I guess if I consider the situation now, we have so many different huge secular trends happening and huge changes going on that it is very, very hard for people to process and to make sense of it. And structurally speaking, it means that we're in a very unstable, fast-changing world. And the fact that everyone's got BlackBerries or iPads or Bloombergs or internet access, people get this information relatively quickly, and simultaneously. And so I just try to think about investing by understanding that markets are just the equilibrium of liquidity, of supply and demand. That's all it is. It's not the efficient discounting of the future. It just simply means this is where people are right now. And what I try to do is to align my efforts and my resources and my team to look at these big things. Are we at peak? Do we have peak oil or not? How is the Chinese economy growing, and what industries is it affecting at different times? What will the internet? What industries will it be affecting next, and how will it destroy, high-cost offline areas or competitors? These are all big structural areas of research, and we try to do that, learning from the companies involved with those, but also studying the structure of those situations and problems and industries, to then blend to have a portfolio that we think is anticipating something different happening that's generally happened before.
It seems, by all accounts, you've done a very good job at doing that. Now during the debate over financial regulation reform the past couple of months, there was a lot of talk on the shadow banking system, if you will, that had sprung up over the past 10 to 20 years outside the purview of regulators. And hedge funds were a frequent target for that sort of accusation. Do you think that's a fair characterization?
No, of course not. I mean, the biggest risks markets face are the lack of understanding of the regulators, and for them changing rules inappropriately, and for the very, 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 very large banks who take, the nation's deposits and then lend them, often inappropriately, taking risks that are inappropriate. Those are the big things. But the hedge funds who have no fallback position are the most responsible risk takers around.
Now, do you think that the 13F filings that hedge funds are required to file are unfair in the way that they force hedge fund managers to reveal their strategies?
Yeah, but yes, but it's I'm not actually so upset about transparency, because I think that's actually a trend that we should all expect. If you really want to be opaque, there are ways of doing it. But like, for instance, we typically take positions and tell our investors about it and tell the world about it. The question is whether the people are going to believe our views. We don't mind if they know what we own or what we're short.
Okay. Now on that note, are there any other money managers or traders that you follow in particular?
Yeah, I'd say probably more the ones who have expressed tremendous skepticism about the current environment. I mean, I started 10 years ago, exactly on August 1st, and my belief was that the market was extremely expensive, which it was, and I've been essentially betting against the U.S. market for 10 years, first the equity market, and then as I watched the government, the Fed, et cetera, prop up things and lower interest rates and do all the things they did to avoid recession, started betting against financials and other things. And now I'm in the position of regarding the government as an enormous risk to all of us and all of our wealth and sovereignty. And therefore, I pay particular attention to those who have views about that, because I want to learn from them. I want to follow, their thinking, and also as a means of discounting, the positive stories that one always hears around the market.
So do you see a political element to investing over the next, say, 5 years?
Yes. So I started, my first job was in an emerging market fund, a very small one, 1996. And when you were regarding emerging markets back then, but even now, you had to do a macro analysis first about the government, the fiscal situation, the monetary situation, value of the currency, understanding of the industries they had, what they lacked, what they had. And 15 years ago, Americans didn't care about the macro. The macro had been with Americans for a long time, which is why you have so many dedicated bottom-up investors as Americans, so many quote-unquote value investors, because for the most part, they didn't have to worry about the macro. But if you've been involved in any other country, for the most part, you've had to do that. And now, essentially, America and the government has so misregulated and now mismanaged its own finances that you have to regard the government and look at it like an emerging market and do the same analysis about the situation, because essentially you shouldn't buy a security in a market if you don't understand if it's unstable, if you don't understand how it may change. And that essentially is what I think we're going to be looking at and dealing with the next 5-10 years.